So I forgot to record, sorry. So for Camelite A, we are doing the same thing what we did in Copies Express. It's basically same. PAT is 39375, interest expense we added back, got the operating profit, added back the DA, we got the EBITDA. Then accruals, receivables, change in inventory. We have paid for our cash is stuck, so the receivable is increased. It was zero, there was nothing, so it increased, so it will be negative. And inventory also we have some stock for which we paid, but we have not got the money yet by selling it or whatever. So it's also the negative cash flow. So net cash flow is this. Then for machinery, the total cash flow is 62,500 paid there and 1,50,000 was paid there. So sum of it. We won't take depreciation because we didn't get any money back or we paid for depreciation. It's just for the calculation, right? And for the interest expense, it is financing minus 750. So the summation of these three is this, which should be same as opening cash flow minus closing cash flow, same value. So it's correct. So let's move to the next. So and we're doing Camelite B because it's same as Camelite A and Copies Express, but I'll go through it once for my own sake. I'm not doing direct method. I will be focusing on indirect method. So net income before tax is already given, right? EBIT, sorry, net income before tax is, yeah, earning before income tax. So income before tax is given, we're writing down it. And then gain in other, so it's other income or gain on sale of equipment. So those kind of things are there. It, yep, this was again, so I'm removing it again and then adding back the interest expense to get the operating profit and then adding back the DA. DA is given as depreciation is this much, amortization is this much, addition of 2 our DA. We are adding that back and got the EBITDA. Then change in receivables. So receivables increased, so more money got stuck, so negative cash flow. So the difference, the negative sign of the difference, raw materials increased, so again more money went for inventory raw material. The difference is also in negative. Inventory was zero and more FG is there, so obviously negative. But there was written somewhere that uh, there was somewhere it was written, yeah, a finished goods inventory includes 5,000 depreciation. So due to that, we are uh, removing 5,000 from that and taking that as a negative cash flow because 5,000 is in the depreciation. We already had calculated it here. So prepaid insurance, prepaid insurance was zero and 65,000 got paid. So also a negative cash flow. So this is the impact of accruals. If you add it with the EBITDA, you will get cash generated from operations, and then minus the income tax paid, you will get net cash flow. Now, how much income tax we paid? So income tax is 64,930, right? Right. So income tax is 64,930 and taxes payable got decreased. So we paid some of it. So the difference, if we paid some of it, so more 950 was added with it. So plus 64930 minus deferred taxes. So deferred taxes got increased. So we don't have to pay that. right? So there is a positive cash flow. So we'll add this. So 39,150, and yeah, this the amount is the income tax we paid, and proceeds from sale of equipment. So payment towards purchase of PPE is basically land bought for 2500, this amount, PP bought this amount. So, and adding those two, whatever the amount is, from that we have not paid for half 425,000. So the difference is what we have paid, right? So adding those two will be 137,000, this one, and minus the value, minus 42500 is 94,500, that is payment towards the PPE. And now proceeds from sale of equipment is a tricky one. You can just write it down from reading the statement. It was there that the selling price of the old machine is estimated to this value. Or what you can do is calculate it from the balance sheet. So for that you need to remember Chamelite A. So in Chamelite A, if you remember, we have added the depreciation for 6 months, 10,625, right? Which is given as this value. And the selling will happen at the end of the year, right? So what would have been the net book value at the point of selling? This minus the depreciation. So this minus the depreciation, which was 6 months depreciation, right? And minus this depreciation again, cause so this is the net book value, and if you add it with the gain on sales equipment, sorry, where it went? Okay, sorry, these are in already negative terms, so add only. So this is the value. So why it is happening is, if you read the statement, it was written that the cash transaction will take place in late June. So there will be 6 months depreciation again, right? So this was the PP value, and this was the depreciation for the 6 month of the last year. And again for this year, again you have to minus the depreciation. So you will get the net value, which is this, and in that you have gained this much. So add it. So you will get the money cash you got from the sale. So this is the value. Now this is the equivalent net cash. For issuance of long-term debt is basically change in long-term debt. Issuance, so it increased, so we got money. Issuance of short-term debt is short-term debt. Purchase of treasury stock. So treasury stock we have given 26,000 we have uh, purchased, so it's negative, so we paid for it. So this is negative. Interest paid we can get from uh, interest expense, it is 58750, and dividend paid is written at 10,000. In the case study, which was at the beginning of 10,000 we paid. Also, it is written in some other place. Yeah, in January 2005, we paid dividend of 0.02 per share. So we have 5 lakh share into 0.02. It's around 10,000, I guess. Yeah. So net is this. Sum of it, sum of these three will be this value, and cash at the beginning was this value, and if you minus it with this, you should be left with the value which is similar to this value. That is how you check if it is correct or not. Now, Chamelite is done. So after that, I think CMOT was there, yeah. So in CMOT, tell me us. Yep, so for here, income statement and balance sheet was already given. And I'll again do the indirect method only. So start with the income before taxes. Okay, income before taxes 1997, and from that add back the expenses and remove the other incomes, which is also given in the other total other income 908 and total other expense bars 1205, and we will get it operating profit. Add back the depreciation and amortization, same. You will get the EBITDA. Then for the accruals, you have to go one by one with the balance sheet. So first is note receivable, sorry, receivable should be there, right? Accounts receivable. So it got decreased. So that means people paid, some people paid us. Right. So we got some cash. So the difference, positive of the difference will be taken. Then prepaid expense or current asset. Current asset also got in decrease. So maybe we sold some current asset or whatever happened, we got some money back. So 6 will be in positive. Then accounts payable. So then if you see after that, real estate, held for sale, these are not, you know, operating receivable, operating accruals. The next operating accruals is accounts payable. So it got increased. So we didn't pay 245, the difference. So we hold like held our money back. So 245 is again the positive will be taken. Then accrued land rent again increased, like we didn't pay the land rent and I have the cash, so positive. Accrued compensation also increased. Deferred revenues also increased. So these liabilities increase. This means we have a positive cash flow, right? So we have added everything and deferred other deferred credits also we have added. So 216. So total accruals, effect of accruals and add it back, we will get cash generated from operations. Income tax paid, how are we calculating that? Income tax paid in income statement is given 579 is what our bill is, and then we have to check here the income tax related things. So in here we have that income tax payable is 100 increased. So 579 minus 100, 479 is what we paid. Okay, but again you have to find other things. So here you can see deferred income tax, which is again related to income taxes. So it also again increased. So we held back that cash. So 479 minus 479 is zero basically. Okay. Now these values are totally given from the exhibit 4. So first, if we go one by one, cash dividend is paid 11200. Cash dividend is financing activities, so 112. So after that, this was related to income tax that they didn't pay. Now this from this you can see we got 11000, right? So 110 is the cash we received. write it down 110 proceeds from real estate sale. Then purchased equipment of total 5146. So 5146 we purchased, negative cash flow. Then it was told that 416 we have taken a loan and used it. So as it is written as investment and there were some other logics that the asset is not ready yet, and until asset is ready, anything you pay for it is added back as a capital expenditure. So we will add it back. We have paid. Write it down as 416 in the investment we have provided. So negative cash flow. Then a loan of 85,000. So again minus 85. Then again we have said that capital expenditure relating to real estate is 16,000. That is again we have added at 16,000. Then in notes receivable, we have said that from the notes receivable, we received 48500 and 23,000 receivable for miscellaneous other assets. So that 23 and 485 will be added here, right? So then the others are financing. So these are added, and now here you have to add the other income also, which are in the exhibit 2. If you go to the other income, interest income is and commercial property income and miscellaneous income, you have to add first add these two. You cannot add this one because we have taken this considered it inside of this proceeds of sale of equipment, purchase of PP, this in this thing. So other than that, the other income like commercial property rent and interest income, you can add it here. Okay, and for the miscellaneous, you can write it differently. You can add it up. So income was 26, expense was 132. So 106 was the difference. So net miscellaneous is 106 minus. Okay, so add all of these and you will get net cash from investing activities. Now, issuance of long-term debt is also given in the exhibit 4 that we got this much long-term debt, we paid this much long-term. This is the long-term debt we took, this is the long-term debt we paid. Then issuance of stock, we got 33,000 rupees out of $33,000 out of it. So positive 33, then interest paid, how much that is given here. So we paid it, so negative cash flow, dividend paid was written at the first. And in the cash, here one point was written that 1200 was taken on line of credit and paid. So uh, short-term loan taken was 1200 and then again it was given back. The net is this much. Then if you add these three, the net increase in cash and cash equivalent is this. And the beginning, if you add it from that, it will be same as the ending. So that you always have to check in the exhibit 3. Let's see, change is 825. So here it's 825, so it's fine. And the difference, the ending is 4097, so it's 4097, so it's correct. Again, I'm not doing the direct one, it's because I didn't, as I said, we don't need it in the exams. So that was CMOT. Then BNL stores. Yeah, so I think I will do the BNL stores one by one. And so I'll stop the video here where I have just explained it by looking at the balance sheet and income statement. So I'll do the BNL sheet and Zenmo. and I'm skipping Stafford. Bye bye.